Picture four coworkers who each receive a surprise bonus of $100,000 on the exact same day. The first puts it into an index fund and forgets about it. The second hands it to a mutual fund manager who promises to beat the market. The third buys a basket of ETFs from her phone during her lunch break. The fourth wires it to an exclusive hedge fund that only accepts wealthy clients. 20 years later, they meet again. One of them has quietly become a millionaire. One of them paid so much in fees that their returns barely beat inflation. One of them got lucky for a few years, then lost it all in a single bad bet. And one of them built slow, boring, unstoppable wealth without ever checking their account. By the end of this video, you will know exactly which one is which, and more importantly, which one you should be choosing with your own money today. Most people assume that investing mistakes come from picking the wrong stock. In reality, the far more common and far more expensive mistake is picking the wrong type of fund. A difference of just 1% in annual fees might sound irrelevant, but over 30 years, that single percentage point can quietly erase tens of thousands of dollars from your retirement account. Fees are silent. They do not show up as a dramatic crash on the news. They simply chip away at your future year after year without you noticing. This is exactly why understanding the difference between index funds, mutual funds, ETFs, and hedge funds is not just financial trivia. It is one of the most consequential decisions an everyday investor will ever make, often more consequential than which individual stock they pick. So let's break down exactly what each of these actually is, starting with the one that has quietly become the favorite of the world's most successful investors. An index fund is a type of investment that simply buys every company inside a specific market index, rather than trying to guess which individual companies will win. The most famous example is the S&P 500 index, which includes 500 of the largest publicly traded companies in America. When you buy an S&P 500 index fund, you are not betting on Apple or Microsoft individually. You are betting on the collective success of the entire American economy. There is no highly paid manager trying to outsmart the market inside an index fund. Instead, computers simply replicate the index automatically. This is called passive investing, and it is the reason index funds tend to carry incredibly low fees, often a fraction of a single percent per year. Warren Buffett, one of the greatest investors in history, famously bet a hedge fund manager that a simple, low-cost index fund would outperform a basket of actively managed hedge funds over 10 years. Buffett won that bet decisively, and that single wager became one of the most famous case studies in the entire investing world. A mutual fund pools money from thousands of investors and hands that money to a professional fund manager, who then decides which stocks, bonds, or assets to buy on behalf of everyone in the fund. Unlike an index fund, most traditional mutual funds are actively managed, meaning a human being or a team of analysts is constantly researching and trading in an attempt to beat the market. This active management comes at a cost. Mutual funds typically charge higher fees than index funds, often between 0.5% and 2% annually, to cover research, trading, and manager salaries. Some mutual funds also charge an additional sales fee called a load, simply for the privilege of investing your own money with them. Here is the uncomfortable statistic most mutual fund companies do not advertise. The vast majority of actively managed mutual funds fail to consistently beat simple index funds over long periods of time, according to numerous long-term industry studies. Investors are often paying premium prices for performance that does not actually outperform a much cheaper alternative. That said, mutual funds are also typically bought and sold only once per day at a set price. And many retirement plans, including many workplace 401k accounts, are built primarily around mutual fund options, which is why understanding them still matters enormously. An ETF, short for Exchange Traded Fund, is similar to an index fund in structure, but with one major difference. ETFs trade on the stock market throughout the day, just like an individual stock. This means you can buy or sell an ETF in seconds at whatever price the market is currently offering, rather than waiting until the end of the trading day like a traditional mutual fund. Companies like Vanguard, BlackRock, and Fidelity have built massive ETF empires by offering incredibly cheap, diversified baskets of stocks that anyone can buy with just a few dollars. There are ETFs that track the entire stock market, ETFs focused entirely on technology companies, ETFs built around real estate through REITs, and ETFs covering nearly every sector imaginable. Imagine a young nurse named Priya who has $500 to invest for the first time. Instead of trying to pick individual stocks, she buys a single ETF that instantly gives her ownership in hundreds of companies at once. With one purchase made from her phone in under a minute, she achieves instant diversification that would have taken enormous time and money to build manually just a few decades ago. ETFs combine the low cost of index investing with the flexibility of instant trading, which is exactly why they have exploded in popularity among younger investors over the last 2 decades. A hedge fund is a private investment fund, typically reserved for wealthy individuals and large institutions that uses aggressive and often complex strategies to try to generate outsized returns. Unlike index funds and most ETFs, hedge funds are not simply trying to match the market. They actively trade, use leverage to amplify their bets, and frequently use short selling, a strategy that allows them to profit when a stock's price falls rather than rises. Hedge funds also typically charge a notoriously expensive fee structure, often summarized as 2 and 20, meaning a 2% annual management fee plus 20% of any profits generated. This means even in an average year, a hedge fund manager can earn a substantial fee regardless of whether their clients actually beat the market. Consider the story of long-term capital management, a hedge fund in the 1990s run by literal Nobel Prize-winning economists. For years, it generated extraordinary returns using highly sophisticated mathematical models. Then in 1998, unexpected global financial turmoil caused the fund to collapse so dramatically that it required a coordinated bailout from major Wall Street banks to prevent a wider financial crisis. Hedge funds can generate extraordinary returns in the right hands, but they can also carry extraordinary risk, extraordinary fees, and are typically completely inaccessible to everyday investors due to high minimum investment requirements. Numbers rarely lie, but they are frequently misunderstood. Historically, low-cost index funds tracking major markets like the S&P 500 have delivered average annual returns of approximately 10% before inflation over long multi-decade periods. Actively managed mutual funds as a category have historically struggled to consistently beat that benchmark after accounting for their higher fees, according to numerous studies published by financial research firms over the past several decades. Hedge funds, despite their reputation for exclusivity and sophistication, have always frequently underperformed simple index funds as an entire industry average. Once their substantial fees are factored into the equation, even though individual hedge funds occasionally produce spectacular short-term results. ETFs, since many of them simply track the same indexes as index funds, have historically delivered extremely similar performance results, with the primary difference being trading flexibility rather than actual investment returns. The uncomfortable truth revealed by decades of data is this: complexity and exclusivity do not automatically translate into better returns. Often the simplest and cheapest option has quietly outperformed the more sophisticated and expensive alternatives. Fees are the quiet wealth killer that most beginner investors completely underestimate. Imagine 2 friends who each invest $10,000 at age 25, earning identical 7% average annual returns before fees. One pays a fee of 0.1% annually through an index fund. The other pays 2% annually through an actively managed fund. By the time both friends reach retirement age, that seemingly small fee difference could easily cost the second friend well over $100,000 in lost growth, simply because fees compound negatively over time, exactly the way returns compound positively. Index funds and most ETFs typically carry the lowest fees in the entire industry. Mutual funds carry moderate to high fees depending on the specific fund. Hedge funds carry by far the highest fees, often making them profitable primarily for the fund managers themselves rather than their investors. Understanding fees is not a boring technicality. It is one of the single most powerful factors determining your actual long-term wealth. Every investment fund carries risk, but the type and intensity of that risk varies dramatically. Index funds and broad market ETFs carry market risk, meaning their value rises and falls along with the overall stock market. During a crash, they will drop in value, but historically they have also recovered over time alongside the broader economy. Mutual funds carry similar market risk, plus an additional layer of manager risk, since their performance depends heavily on the skill or lack of skill of whoever is actively managing the fund's decisions. Hedge funds carry the highest potential risk of all four options, since many hedge fund strategies involve leverage and short selling, both of which can dramatically amplify losses just as easily as they amplify gains. A hedge fund betting incorrectly on a falling stock price can theoretically lose far more money than it originally invested. Sector-specific ETFs also deserve a mention here, since concentrating your money into a single industry, like technology or energy, carries significantly more volatility than a broad, diversified index fund covering the entire market. Liquidity determines how quickly you can convert your investment back into usable cash. ETFs offer the highest liquidity of the four options, since they trade instantly throughout the day, just like individual stocks, allowing investors to buy or sell within seconds during market hours. Index funds and mutual funds are typically only priced and traded once per day after the market closes, meaning your buy or sell order executes at that day's single closing price rather than in real time. Hedge funds offer by far the worst liquidity of the group. Many hedge funds require investors to lock up their money for months or even years through restrictions known as lockup periods before they are permitted to withdraw funds at all. For everyday investors who value flexibility, this liquidity difference is often a decisive factor when choosing between these options. Taxes quietly determine how much of your investment return you actually get to keep. ETFs are generally considered the most tax-efficient option among the four due to their unique structure that typically minimizes taxable events until you personally decide to sell your shares. Mutual funds, by contrast, can sometimes generate unexpected taxable capital gains distributions at the end of the year, even if you personally never sold a single share, simply because the fund manager was actively buying and selling securities inside the fund on your behalf. Index funds generally offer solid tax efficiency as well, since their passive, low-turnover strategy naturally results in fewer taxable events compared to actively managed alternatives. Hedge funds often involve complex and less tax-efficient structures, particularly due to frequent short-term trading, which can generate higher tax rates on short-term capital gains compared to long-term investment strategies. Holding any of these investments inside tax-advantaged retirement accounts, such as a 401k or an IRA, can further shield your gains from taxes for decades, regardless of which fund type you choose. If you only had $500 to invest today, a low-cost broad market ETF or index fund would almost certainly be the most practical starting point, thanks to instant diversification and minimal fees. If you wanted complete simplicity and were investing through a workplace retirement account, a well-chosen mutual fund might be your only realistic option, making it important to specifically look for lower-fee mutual funds within your available choices. If you hated risk and wanted the smoothest possible investing experience, broad index funds tracking the entire market would typically provide more stability than sector-specific ETFs or individual stock picking. If you wanted maximum long-term growth with minimal ongoing effort, historical data strongly suggests that low-cost index funds and broad ETFs have provided some of the most reliable, long-term results available to everyday investors. Hedge funds, meanwhile, remain largely inaccessible and unnecessary for the vast majority of beginner investors, both due to high minimum investment requirements and substantial associated risk. There is no single universal winner here because different investors are optimizing for different goals. For long-term retirement investing, low-cost index funds and broad ETFs have historically built substantial wealth for millions of ordinary Americans, primarily through consistency, low fees, and decades of compound growth. For passive investing with minimal effort, ETFs offer an unmatched combination of low cost, instant diversification, and trading flexibility. For sophisticated wealthy investors seeking potentially higher returns through complex strategies, hedge funds may occasionally outperform, though typically only for a small percentage of top-performing funds, while charging substantial fees along the way. For workplace retirement investing, mutual funds often remain the primary available option, making it essential to specifically seek out lower-cost funds whenever possible within your plan. The strategy that has quietly built the most reliable long-term wealth for the largest number of everyday Americans has consistently been the simplest one: low-cost, broadly diversified index investing held patiently for decades. So which fund actually wins? Index funds, mutual funds, ETFs, or hedge funds? The uncomfortable truth is that the most complex and exclusive option is rarely the one that builds the most reliable wealth for everyday investors. Simplicity, low fees, and patient long-term diversification have quietly outperformed complexity and exclusivity for millions of ordinary Americans over the decades.